The Social Security Administration operates strictly as an administrative processing entity, governed by Title II and Title 18 of the Social Security Act and Title 20 of the Code of Federal Regulations, rather than functioning as an advisory, legal, or fiduciary entity. Under established federal statutory frameworks, the agency possesses no legal mandate, fiduciary obligation, or affirmative administrative duty to evaluate a worker's personal domestic circumstances, proactively cross-reference database files, or recommend strategic filing choices that would maximize total household financial outcomes. Although the central master database repositories of the Social Security Administration store detailed lifetime earnings histories, marriage licenses, divorce decrees, tax withholdings, and secondary worker filings under unified Social Security numbers, no automated system algorithm or agency official is assigned to cross-reference these individual files to flag underpayments, identify retroactive claims, or notify individuals who are currently receiving significantly less than their maximum statutory entitlement. The entire legal burden of initiative, evidence gathering, document verification, and formal written application rests solely on the individual claimant. Without explicit written filings submitted on exact official agency forms, earned statutory benefits remain uncalculated, unissued, and held indefinitely within federal trust funds. The fundamental computational baseline for all retirement, disability, auxiliary, and survivor entitlements is the primary insurance amount, which is derived directly from an individual's average indexed monthly earnings across their highest 35 years of indexed wage records under Title 20 of the Code of Federal Regulations, Section 404.211. Lifetime nominal wages are historically adjusted using the National Average Wage Index to account for economy-wide wage growth over time. Indexed earnings are capped in each given year by the statutory national contribution and benefit base. If any single year within those top 35 calculation years contains an unrecorded zero, an omitted employer, an unposted contract payment, or an understated wage figure, the resulting baseline primary insurance amount remains permanently depressed across the beneficiary's entire lifetime. When annual wage reporting fails due to simple typographical errors on Form W-2 wage statements, legal name changes following marriage or divorce, transposed Social Security numbers, or employer payroll reporting mistakes, those unallocated tax funds are automatically funneled into the agency's internal earnings suspense file, managed under Official Program Operations Manual guidelines. This unposted administrative repository currently holds over $1.9 trillion in total unmatched lifetime wages, with approximately 8.5 million new unallocated wage items added during every single tax year. Section 205, subsection C, subsection 4 of the Social Security Act establishes a strict statutory deadline of 3 years, 3 months, and 15 days following the close of any given tax year to formally request an earnings record correction. Beyond this precise timeframe, the master earnings record is legally presumed to be correct as a matter of law. However, critical statutory overrides under Title 20 of the Code of Federal Regulations, Section 404.822, permanently bypass this time limit if an employer completely omitted wages for a reporting period, if an administrative error is facially evident on internal agency processing files, or if the worker provides conclusive corroborative evidence comprising timely filed Internal Revenue Service Form 1040 tax returns, original W-2 statements, or employer pay stubs submitted alongside a formal Form SSA 7008 request for correction of earnings record. Spousal insurance entitlements authorized under Title 20 of the Code of Federal Regulations, Section 404.330, allow a legally married partner to claim up to 50% of the primary earning worker's unreduced primary insurance amount at full retirement age. Standard online benefit applications process claims strictly under the applicant's own primary worker record by default. If an applicant's personal lifetime retirement benefit is lower than 50% of their partner's baseline primary insurance amount, the claimant must explicitly submit Form SSA-2 to receive the dynamic spousal top-up payment. Under comprehensive deemed filing rules established by the Bipartisan Budget Act of 2015, filing for a personal retirement benefit automatically acts as a concurrent application for spousal benefits whenever dual eligibility exists, eliminating the historical ability to claim restricted spousal benefits while delaying personal retirement growth. For dissolved marriages, program rules detailed in Program Operations Manual, System Section RS 00202.005 establish independent eligibility for divorced spousal benefits using Form SSA-2 if the underlying marriage lasted for at least 10 consecutive years immediately prior to final divorce. The claimant is currently unmarried, and both former spouses have attained at least 62 years of age. Under the independently entitled divorced spouse rule, if the divorce decree has been final for at least 2 consecutive years, the applicant can successfully file Form SSA-2 regardless of whether the former spouse has actually claimed or started drawing their own retirement benefits. Claims filed on an ex-spouse's record carry absolutely zero administrative crossover. The agency does not notify the ex-spouse, no personal authorization or signature is required from the ex-spouse, and payments drawn do not reduce the former partner's personal benefit or impact the maximum family benefit cap of their current household. Upon the tragic death of a covered worker, Title 20 of the Code of Federal Regulations, Section 404.335, governs widows' or widowers' insurance benefits, allowing a surviving spouse to receive up to 100% of the deceased worker's actual monthly benefit rate. While reporting a beneficiary's passing through a funeral home or mortuary automatically triggers a nominal, one-time $255 lump sum death payment under Title 20 of the Code of Federal Regulations, Section 404.390, it never initiates recurring monthly survivor payments. Recurring survivor benefits strictly require the explicit manual submission of Form SSA-10. Survivor claims are bound by a rigid statutory retroactivity cap under Title 20 of the Code of Federal Regulations, Section 404.621, and Program Operations Manual System Section GN 00204.030, which restricts back payments to a maximum of 6 months prior to the exact calendar month Form SSA-10 is formally submitted. If a surviving spouse delays filing for 18 months after a partner's passing due to grief or lack of procedural awareness, federal law permits back payments for only the preceding 6 months, causing the remaining 12 full months of uncollected monthly benefits to be permanently forfeited without administrative recourse. Furthermore, under Retirement Insurance Benefit Limit Calculation Rules detailed in Program Operations Manual, System Section RS 00615.320, if the deceased spouse filed early and was receiving reduced monthly checks, the survivor's check is capped at the higher of the reduced amount the worker was actually drawing at death, or 82.5% of the worker's unreduced baseline primary insurance amount. Widows and widowers retain the explicit statutory right to sequence their benefit elections, such as drawing a reduced survivor benefit as early as age 60, while allowing their own personal retirement benefit to accrue delayed retirement credits up until age 70, or vice versa, depending on which underlying record yields the higher long-term financial yield. Because Social Security benefits are legally paid 1 month in arrears pursuant to Title 20 of the Code of Federal Regulations, Section 404.311, A beneficiary who survives through the final second of a calendar month has legally earned that entire month's benefit check. However, if that beneficiary dies in the subsequent calendar month, before or shortly after the direct deposit arrives in their financial account, Federal Treasury regulations under Title 31 of the Code of Federal Regulations, Part 210, mandate that financial institutions automatically reverse and return all benefit deposits received after the exact date of death. When direct deposits are clawed back from bank accounts by the Department of the Treasury, the returned funds shift into a distinct administrative status known as a federal underpayment. To successfully reclaim these legally earned funds, along with any refunded Medicare premiums withheld for future months, surviving family members must file Form SSA 1724. Under Section 204, Subsection A, Subsection 2 of the Social Security Act and Program Operations Manual, System Section GN 0201.001, underpayments cannot be distributed through informal phone requests or governed by private wills and state probate proceedings. Instead, underpayment funds are dispersed exclusively according to a strict federal legal hierarchy that prioritizes surviving spouses living in the same household, followed by benefit-entitled surviving children, surviving parents, non-household spouses, and finally, court-appointed estate representatives. Form SSA 1724 cannot be processed online and must be physically submitted directly to a local Social Security field office with primary documentation. Electing retirement benefits prior to reaching full retirement age results in a permanent, lifelong reduction in monthly checks of up to 30% at age 62, whereas delaying claims past full retirement age earns delayed retirement credits under Title 20 of the Code of Federal Regulations, Section 404.313, that systematically increase the monthly payout by 8% simple interest per year up to age 70. For individuals who filed early but later experience a financial recovery, return to high-earning employment, or wish to halt the compounding lifelong loss of early filing, Title 20 of the Code of Federal Regulations, Section 404.640, provides a critical administrative reset mechanism known as Form SSA 521, Request for Withdrawal of Application. An approved withdrawal completely cancels the original benefit application as though it was never filed in the first place, allowing the worker's underlying benefit baseline to resume compounding at the full delayed credit rate. To successfully execute Form SSA 521, the written withdrawal request must be formally submitted within exactly 12 calendar months of the original entitlement approval date. The applicant must fully reimburse the agency for 100% of all gross benefits distributed, including withheld taxes, Medicare Part B premiums, and auxiliary checks paid out to family members, and all auxiliary beneficiaries receiving checks on that record must provide formal written consent. Individuals are legally permitted to execute an application withdrawal only once during their lifetime. For beneficiaries actively drawing Social Security checks, standard Medicare Part B monthly premiums are automatically deducted directly from monthly benefit distributions under Title 18 provisions. However, low-income beneficiaries may qualify for state-administered Medicare savings programs that fully absorb these monthly insurance costs and restore the withheld deductions back into the recipient's monthly Social Security check. Under the Qualified Medicare Beneficiary Program authorized by Title 42 of the United States Code, Section 1396A, Subsection N, Subsection 3, federal law imposes an absolute prohibition on healthcare provider balance billing, strictly forbidding Medicare participating physicians, specialists, and hospitals from billing enrolled patients for any Part A or Part B cost-sharing amounts, including annual deductibles, coinsurance percentages, and statutory copayments. If a medical provider improperly bills a qualified Medicare beneficiary and collects out-of-pocket payments, those charges constitute an explicit violation of federal provider agreements, and the beneficiary is legally entitled to demand an immediate, full financial refund through state compliance offices. Social Security benefits are also subject to federal income taxation under Internal Revenue Code Section 86, based on an individual's total provisional income, which is calculated by adding adjusted gross income, tax-exempt bond interest, and exactly 50% of gross Social Security benefits. Depending on filing status and total provisional income thresholds, up to 85% of an individual's Social Security benefits become fully subject to federal income tax. Because the Social Security Administration does not withhold federal taxes from monthly checks by default, retirees who receive secondary pensions, traditional individual retirement account distributions, or investment gains frequently trigger mandatory tax underpayment penalties under Internal Revenue Code Section 6654 when filing annual tax returns in April. Submitting Internal Revenue Service Form W-4V directly to a local Social Security field office allows beneficiaries to elect a voluntary federal tax withholding rate of 7, 10, 12, or 22% directly from each monthly check. All legitimate claims, benefit adjustments, and record corrections require original primary evidence, such as certified birth records, original marriage licenses, or official military discharge documents, sent via certified mail or delivered during in-person agency appointments. Beneficiaries must maintain continuous vigilance against unsolicited telephone calls, text messages, or unofficial emails claiming to offer emergency lump sum disbursements, benefit increases, or account suspensions, as official Social Security Administration business is conducted exclusively through authenticated personal online accounts on SSA.gov, official postal mail, or direct scheduled appointments at local federal field offices. Maintaining meticulous personal copies of all submitted forms, proof of mailing receipts, and written agency notices remains the single most effective defense against administrative oversights, lost records, and uncollected federal entitlements.